My next guest says the short-term pain in emerging markets is likely to continue, but he remains bullish on the long-term prospects, especially on Russian equities. Scott Licamelli is the director of Red Star Asset Management. He joins us now. Scott Licamelli, welcome.
Thank you.
So, Scott, why so enthusiastic about, for example, Russian equities? They've already had a very big run this year, and isn't that all commodity and resource-based?
Yes, certainly. I mean, you know, Russia has been a significant beneficiary of the run we've seen in emerging markets, you know, on a broad basis throughout the BRIC markets. But definitely, I would say that there is value to be found, especially as a lot of these Russian oil stocks that are focused more in the upstream are re-rated due to increased assumptions regarding average oil price for this year. So that's one area where we see there's opportunity in Russia, despite the significant run-up we've seen. That said, I would say outside of the oil and gas sector, I would be a bit wary to take the plunge on the long side aggressively right now, given the significant run-up we've seen off the 52-week lows in Russia.
Scott, do you see some kind of irony in this? I mean, when we talk about China, for example, we talk about the government trying to refocus stimulus to the domestic economy so people play the domestic economic names. Now, in Russia, what about the domestic economy? Is that an area for investors to go hunting?
Well, they've been hunting very aggressively. I mean, if you look at, take, for example, Wimbledon, a dairy and fruit juice and baby food manufacturer in Russia, it's up 300% off its 52-week lows, and actually just over the past couple of days, it's the target prices have been upgraded by a number of brokers. So we've already seen a lot of money coming into these consumer stocks and these consumer plays based on issues associated with import substitution, and so we definitely like these stories. However, right now we're net short in Wimbledon. We think that it's only about maybe 18 or 19% shy of its just recently upgraded target price on an average basis, and we feel that perhaps the domestic consumer names have gotten a bit ahead of themselves, given the overall run-up we've seen in the market.
All right, so you want to stay focused on the resource plays, is that it?
Yes. I mean, we feel that there's certainly room up for a re-rating, particularly in the Russian oil stocks. We like Gazprom. We feel that it's pretty much been rising in line with the overall index. There have been some other great performers, but we feel that Gazprom has a ways to go. It hasn't really caught up in terms of the, we think there's potential upside there. Also, from a liquidity perspective, there's liquidity in the name, and we think there's significant upside there. We also like the upstream plays, such as, or companies with exposure to upstream, such as Lukoil or Rosneft that have significant upstream exposure. We feel that as the oil prices assumptions are increased, we're confident that these names will continue to perform. But we could see, and I think we are seeing, obviously, a lot of short-term volatility in the market.
But, Scott, let me put it to you. I mean, if the developed world, let's say the G8, including the United States, and Western Europe, if they pull the stimulus out too soon, doesn't that hurt emerging markets? I mean, is this price of oil and your resource plays, that kind of floating on the back of U.S. and other developed nation stimulus packages?
I would agree, because certainly the inflationary bias, assuming we see the stimulus packages, reduced or phased out, clearly the fear of at least an immediate inflationary pressure, carrying through to hard commodities prices, that's kind of pushed to the side. And obviously, if you look at the rise in oil prices that we've seen thus far, it's really more based on OPEC cuts, production cuts, rather than increased aggregate demand for oil. So I agree with you 100%. If we see a phase out in these stimulus packages, and if there's a perception that inflationary pressure, at least for the remainder of this year, is not mounting, then I think we could be in for a negative surprise in terms of weaker oil prices. And clearly, the decoupling argument holds, and I believe that in countries such as China and India, where you have strong domestic growth stories, you can get away with focusing on a lot of these domestic consumer names. But in a case like a country such as Russia, which is so utterly dependent on hard commodities, it is entirely about the oil price. So if you are an oil bull this year, then you definitely want to remain in these names. If you feel that there's short-term downward pressure there, then obviously you need to be very careful. And that's why we would stay away from refiners and downstream plays there too, especially.
Well, that's where I wanted to go with you, because I mean, you mentioned Gazprom, you mentioned Lukoil, and we know that ConocoPhillips has a large stake in Lukoil. What about Rosneft, for example? Is that an area as well?
Yeah, I mean, in terms of where we see opportunities, we definitely think that that Rosneft is an interesting play. Again, we speak more in terms of the medium term, to holding these names to year end. Short-term trading of companies, particularly such as Rosneft, we see them. That's a very dangerous game to get into. I mean, if you look at Russia, the flows that we've seen, I mean, there are about $30 billion have flowed back into emerging markets year to date, but within Eastern Europe, there's been an outflow of $500 million. So, and half of all the money that has flowed in to Eastern Europe over the past months has been more related to ETF tracking indexes. So, this is a very, very dangerous game. We've seen a lot of price action with a lot lower volume than we had seen, over the past years in Russia specifically.
All right, we're going to continue the conversation more with Scott Licamelli of Red Star Asset Management. We're going to talk about how oil prices could affect the Russian economy, but also how it could affect the economies of Russia's neighbors, specifically Ukraine, Latvia, the Baltic nations. Find out if these are emerging markets worth taking a risk in. This is Taking Stock on Bloomberg. pfox11 at bloomberg.net if you wish to reach out to us. This is Taking Stock on Bloomberg. I'm Pim Fox. I'm speaking with Scott Licamelli. He is the director of Red Star Asset Management. Scott Licamelli, emerging markets don't always just emerge straight up in one direction. Talk a little bit about what's been going on in Ukraine. We know that they have oil and gas deals with Russia. Specifically, gas prices are a big deal to what happens in the Ukrainian economy.
Yes, for many years, since the collapse of the Soviet Union, the Russians have been subsidizing the natural gas prices that the Ukrainians are paying, and there are all sorts of very convoluted schemes regarding the transit of gas through Ukraine, which are perhaps the topic of another discussion. But in any case, yes, Ukraine is extremely dependent on that negotiating process. They're constantly at odds with the Russians. They're trying to lower, keep the price lower or subsidize. The Russians obviously want market price, which is, in my opinion, the correct approach. But clearly they're negotiating. It's had a very severe impact on Ukraine. In addition to the financial shock that they went through, they also had increased gas prices earlier this year following the mini crisis they had in January. So definitely the country is also in a state of political paralysis. The party of the regions and Bloc Timoshenko are at obviously odds over the future presidential elections, which apparently will be held in January. So state of political paralysis, pressure on gas price, and the remaining effects of the financial crisis in the country all weigh on prospects there.
Scott Licamelli, is that the same story in the Baltic nations? I mean, we're getting followers writing and asking if you can give us some kind of top-down understanding about what is going on in the Baltic nations, Estonia, Latvia, Lithuania. Are we going to see continued civil unrest? Are the economies in that much of a shambles?
Well, yes. I mean, I think our fund focuses, we're an ex-Baltics fund. We do CIS ex-Baltics. But, I mean, generally the situation there is such that either they're going to have to let their currencies go and devalue, which would have a severe shock on their domestic economies, or they would need to get some sort of accelerated integration, into the European currency, which is probably also unlikely this year, given all of the issues that the EU has to deal with, the European Central Bank has to deal with already. So we don't invest in that region, but we are very concerned that there could be a knock-on contagion effect, especially in the case if the conditions in Latvia, continue to deteriorate further.
What about other emerging markets that are connected to Russia? I know that you want to talk about Kazakhstan. That sounds quite far afield. I mean, this does not seem something for the faint of heart.
Well, Kazakhstan is In Central Asia, it's a very interesting country in the sense that they have tremendous gas and significant oil resources. We like Kazmunai gas as one of our core holdings in the region. We think that on a long-term basis, there's significant upside potential there. If you're bullish on natural gas and oil prices, so we like that story. And even in Ukraine, despite all of the negative factors I was mentioning previously, we do actually like MHPC. It's Mironovsky Khleprodukt. It's a company that is a poultry producer there, and they have benefited quite significantly from the lower costs associated with their business following the devaluation. It's a good import substitution play, so that's a good story. So there are definitely pockets of value to be found in these markets. It's just that you have to be extremely selective. That's why, especially even in the case of Russia, now I would be less interested in just simply buying the index passively, because we've seen such a significant run-up this year, from the lows. Again, it's a very selective process. There, again, another company that another stock we like is Sberbank, the National Savings Bank. We find that to be a much more interesting play on the overall potential for recovery in Russia vis-a-vis specific consumer sector plays. I think it's a much more broader and safer play, and especially given that it's the state savings bank.
All right, well, there you have it. Scott Liccamelli telling us about state savings banks as well as oil and natural gas plays in emerging markets, specifically in Russia.